In 1949, a professor at Columbia Business School wrote a book. In that book, he talked about a made-up business partner named Mr. Market. Every day, Mr. Market shows up. Some days he's super excited and offers to buy your shares for way more than they're worth. Other days he's scared and wants to sell his shares for almost nothing, even though nothing about the business actually changed. Same company. Same people. Just a totally different price, because of his mood. That professor was Benjamin Graham. And one of his students went on to become the richest investor in American history, Warren Buffett. Here's the twist, even Buffett got tricked by Mr. Market's mood swings, and it cost him billions. If it happened to him, it could be happening to you too, right now, without you even knowing it. Stick around, because I'm going to show you exactly how. 20 years after Graham wrote about Mr. Market, an economist named Eugene Fama came up with a different idea. In 1970, he said a market is efficient when prices already include all the information available about the future. This is called the efficient market hypothesis, or EMH. In simple words, whatever price a stock is trading at right now is already the right price, because everyone already knows everything worth knowing. If that's true, then picking stocks is useless. No one can beat the market with skill, only with luck. Never forget to like this video, subscribe to the channel, and turn on the bell notification so you never miss any of our future videos. This idea became the reason index funds exist. For regular people, Buffett actually agrees this is good advice. But he says there's a big problem when people treat this idea as a hard rule, and that's where the costly mistake starts. Buffett has said the market is generally fairly efficient, but trusting that idea too much would be a terrible, terrible mistake. In his 2022 letter to shareholders, he explained why stocks often trade at silly prices, both too high and too low, and efficient markets exist only in textbooks. He even joked about it once. In 1988, he said that teaching so many students and professionals to believe in EMH actually helped him. Because it's a big advantage when your competition has been taught that trying is pointless. In 1984, Columbia University held an event for the 50th anniversary of a famous investing book. A professor named Michael Jensen argued that beating the market long-term was basically impossible. Buffett didn't argue with words, he showed results. He pointed to a group of investors, all trained by Graham, living in different cities, using different stocks, and every single one of them beat the market for decades. Then there's Buffett's own results. From 1985 to 2012, Berkshire Hathaway grew 18% a year, beating the S&P 500 by 7.4% a year, with less ups and downs. Buffett's partner Charlie Munger later said a famous economist kept watching these results and kept saying, this shouldn't statistically be possible, and it kept happening anyway, year after year. Now here's the twist. In 2008, oil prices were over $100 a barrel. Buffett bought a huge stake in ConocoPhillips, betting oil prices would stay high. Then oil crashed. He lost billions. Later, he admitted he got caught up in the excitement, just like everyone else. His lesson from it: pessimism is your friend, euphoria is the enemy. This proves something important. Mr. Market wasn't giving a correct price for oil stocks in 2008, he was giving an emotional one. And even the world's best investor got fooled by it. It happened again with Dexter Shoes in 1993. Buffett thought the company had a strong advantage over competitors, but it disappeared within a few years. He later called it his worst deal ever, a $3.5 billion loss. And it happened in reverse with Google. Buffett skipped investing in it, even though Berkshire's own company Geico used Google every day for advertising. He later said that mistake cost him around $10 billion in missed profits. Buffett says mistakes like this, the ones where you knew enough but didn't act, usually cost more over time than any bad trade you actually make. This isn't just a Buffett thing. In 1996, Fed Chairman Alan Greenspan warned about irrational exuberance as internet stock prices shot up too high, too fast. By 2001, that bubble burst, and companies like Pets.com and Webvan went bankrupt. And in 2013, the Nobel Prize in Economics was given to two people at once. Eugene Fama, who believes markets are always right, and Robert Shiller, who spent his career proving markets are often very wrong. Even the Nobel Committee couldn't fully settle this argument. So here's the actual mistake: it's not just believing markets are usually efficient. The real mistake is trusting the current price so much, whether it's too high or too low, that you stop asking what the business is really worth. Even Buffett, the most disciplined investor alive, got caught by this more than once. If it can happen to him, it can easily happen to you without you noticing. Here's the simple takeaway: for most people, low-cost index funds make sense, even Buffett says so. But no price should ever be trusted blindly, no matter how confident everyone else seems. That gap between usually right and always right is where fortunes are made, and where even legends lose billions. If you find this video helpful, do not forget to like the video, subscribe to the channel, and press the bell icon so you don't miss any future videos. Thanks for watching, and we will see you in the next video.